Last week was another positive week in both the S&P and the NASDAQ. Both of them went up exactly 1.1%, and we still continue to be at massive overvaluation highs. But that doesn't mean that you should bail on everything and get rid of all your stocks. Before we get into that, big week coming up for earnings. Netflix. Everybody's talking about Netflix. Netflix is the big one. I talk about people, the analysts want them to increase their prices. There's a lot of stuff going on. I never even knew WD-40 was its own company. It's reporting. Huntington Bank's reporting. Morgan Stanley's reporting. Johnson & Johnson, Progressive, PNC, Goldman Sachs, Bank of America. Bank of America is reporting. Guys, there's a lot of big companies reporting this week. It's going to be a very good week. So if you want to see our updates and our reportings on some of these companies, make sure you subscribe to this channel and make sure you watch, because we do 4 or 5 videos a week. We talk about the markets. We talk about companies' earnings. So it's a very, very great place to be to get your quick updates on where we stand in the market. Now, going back to the previous conversation, if you're new to our channel, one thing I do is I like to look at major valuation metrics. There are 2 big ones I look at: the stock market to GDP ratio, which Warren Buffett calls the single most reliable metric at any given time of where stock values are, as well as the 10-year cyclically adjusted PE ratio. It takes the last 10 years of earnings, brings it to today, and tells us where are we at today for earnings, for PE ratio. Now, a lot of people criticize the stock market GDP ratio, and I hear it at every major bull market. That's fine, but still remember that the vast majority of companies in this country make their money within this country. And that's why this metric is still reliable. If you don't like it, that's why the 10-year cyclically adjusted PE ratio helps, because it allows you to look at the company's earnings no matter where it's earned. As of this morning, the stock market GDP ratio just crossed the 2.0 mark, which is 112% overvalued going back to 1928. This is data going back to 1928. All right. Fair value of $27.37. Now you might sit there and say, Paul, there's no way stocks are going to fall that much. I'm not saying they're going to fall that much. What I'm saying is, as this number goes up, the next 5 or 10 years will not be as good, probably based on history, as the last 5 or 10 years. And what's going to happen is fundamentals will get better. Stock prices will probably stay stagnant or go down. And you're going to see people starting to give up on stocks a little bit. And that's okay, because as an investor, your goal should be to buy stocks at lower prices. Right now, the fundamentals say, hey, for $1 of profit, you have to pay 30 some times earnings. Let me get into that right now. This is that 10-year PE ratio. And right now, historically, the average is 17.17, and we're at 37.38. Fair value of $26.70, 118% overvalued. Again, take that for whatever you want. There's a future stream of income in the future, a future stream of cash flow. The more you pay for that today, the less return you're going to make. The less you pay for it, the more return you're going to make. The example I always give the high schoolers when I talk to them is, this iPhone's worth $1,000. If you pay $100 for it, your return is a lot higher than if you pay $900 for it, and a lot higher than if you pay $2,000 for it. But we get caught up in the excitement of the markets. Stocks are going up, prices are going up. But you got to remember, when you buy a stock, you're buying a piece of a business. And that business generates cash flow. And that cash flow is going to be what it's going to be, probably regardless of what the stock price does. Now, I'm sure there are some correlations between if the stock goes up, more people get excited about the company, they buy more of the revenue, et cetera. But at the end of the day, the revenue and profit are going to be what they're going to be. So the less you pay for it, the better. Does that mean you have to wait for the absolute bottom? No, you're never going to find the bottom. But the key is, when things are in your favor, you buy. If you're buying individual stocks. But what we encourage people to do is, don't try to time things. Dollar cost average and a low cost ETFs. If you do that, here's what's going to happen. Stock values are going to go like this over time, but the prices are going to go like this. And look what I said different. Stock values go like this. Prices go like this. Price is what you pay. Value is what you get. If you dollar cost average, you're going to overpay, you're going to underpay. But over time, you're probably going to pay some sort of average like that, which means you're going to match the market. And that's all you need to do. You're going to beat 98, 99% of those Harvard MBAs out there managing money just by doing this. Now, is it fun to pick individual stocks? Absolutely. I love doing it. But But I also have ETFs. But I love picking individual stocks. But picking individual stocks is about learning a process and learning a way of inside yourself. Successful stock picking isn't about here. It's about here. Can you stomach a stock going down and you ignoring the news? Because remember, statement I always say about investing, news follows the stock price. When a stock is going up, the news is going to be out there that justifies that stock going up. And when the stock is going down, the news is going to come to the surface to justify the stock going down. And if you don't believe me, go look at history. Go look at the companies that have fallen in stock price that end up rebounding. What happened as the stock price was going down? Eventually, sentiment will shift. Now, does that mean that the BlackBerries of the world and the Enrons of the world aren't going to happen? Of course they're going to happen. But how often do they happen? Not nearly as much as when a great company has a temporary fall in price because the perception of the company's changed. And that's built on itself. What we're trying to do here is change that mentality. We're trying to have you be like-minded thinkers with us, like-minded thinkers with everybody in our community to realize that, hey, we might be overvalued, but there's still good stocks to buy because as people buy the hype stocks, the Mag 7, they're ignoring other stocks that have good values. This is a big mistake that I made in my investing. I just thought that, hey, market's overvalued, everything's overvalued. No, there's still some missed opportunities out there. And that's what's important to do. Still a dollar cost average, hit your goals in a low cost ETFs, but buy individual companies. What we want to have happen this week is every company you have up here that you love, you want them to miss. I repeat that. You want them to miss on earnings and you want them to miss on revenue. Why? Because we want the stock price to fall. And people love beating up a company when they miss. But remember, if you look at history, it's impossible for a company to beat every single time. And if they are, you got to start questioning things. You got to start questioning things. We want these companies to miss so that their stock price plummets. If their stock price plummets, like for example, if you love Netflix at $700 a share, which it was recently, and it went down to $160 at one point, why would you not love it more at $160? The company was bigger. The company had more revenue. It has more cash flow and profit now. You should want that to happen. Now, that might sound counterintuitive. I get it. I get it completely. It was for me the first time I heard it. But over time, you start to sit there and say, yeah, if I'm a long-term thinker and I'm able to control my emotions, it'll allow me to watch these companies fall. American Express, a company that I own, it skyrocketed in price. I only got to buy it once or twice. That kind of upset me. I want this company to plummet. I want it to plummet for good reason, though. What's the good reason? It missed on revenue, missed on profit by a little bit. I don't want it to come out that it's been a big Ponzi scheme the entire time, of course not, or there's some major fraud. What I want it to do is have just the fundamentals continue getting better, but not good enough for investors to justify the high prices. That will drive the stock price down. Same with Netflix, because everybody talks about Netflix. Let's pull up Netflix in our software. This company has absolutely rebounded over the years. Let's check it out. It's currently at $721 a share. This is what I was talking about with this big fall. I think this is $6.99 or so. It fell all the way down here to $160, I believe, and just started to climb all the way back up. And in that time, free cash flow jumped up. Because look at this 5-year free cash flow, only $2.3 billion. Because back here, there was no cash flow. Now they're generating cash flow. Last year, in the last 12 months, $7 billion of cash flow. Now, it's still selling for 46 times free cash flow. But if they'd done this and the stock had stayed at 160, this would be like 10 or 15 times free cash flow. A much better number. A much better number. And that's what we want you guys to focus on. If you're able to understand the fundamentals of the business, if you're able to understand that markets go through cycles, there are 3 guarantees in life: death, taxes, and cycles. If you're able to realize that, you'll realize that once we cycle out of stocks and stock prices go down, it'll be an opportunity for you to accumulate shares, especially if you're sub 50 years old. Now, if you're closer to retirement, different situation for you. Just be ready for volatility. And if you can't stand the fact of stocks not doing great stuff over the next 5 or 10 years, or you can't retire because of it, consider that. Have a conversation in our community about what that means for you. If you can't retire if stocks stayed flat, you need to readjust probably. I'm not telling you I know what's going to happen in the future. We have no idea. But what I am telling you is the last 10 years are going to be very hard to replicate, because look at the SPY over the last 10 years. In the last 10 years, S&P 500 is up 211%, not including dividends. That's tripling in 10 years. That's tripling in 10 years. That's not doubling. 210%, that's 3.1x. Tripling in 10 years. You got to remember that. When you realize that, you have to sit there and say, okay, I've got to be more careful here because it's probably not going to happen in the future. Doesn't mean stocks are going to go to zero. That never happens. That's why if stocks went to zero, we have much bigger problems. But if this all sounds interesting to you, I'm not saying it's going to click immediately. But if it sounds interesting to you, subscribe to the channel. Make sure you watch our videos because we do this and repeat this over and over again, and it will make you a better investor because the part about being a better investor is this part right here, the stomach. Make sure you can stand the ups and downs of the market. Make sure you can avoid the stocks that are flying high that don't make sense and buy the stocks that are under the radar that people are criticizing. Because guess what? We've all seen message boards and people are keyboard warriors out there. It's that cat on the computer, that meme, that Giphy with the cat on the computer going like this. It's easy to sit there and cry and complain. We want you to take all that noise away and understand that you're buying fundamentals. So again, lots of earnings this week. Make sure you subscribe. Thank you for your time.